Before we start the show, Andy, I'd just like to say a quick thank you to our podcast sponsor, Wealth Simple, one of the leading online investment platforms globally. Now, Wealth Simple manages over £3 billion for more than 200,000 customers. Wealth Simple prides itself on providing access to smart, simple investing without the high fees and account minimums usually associated with traditional investment management. In fact, you can open a stocks and shares ISA, a SIP or a junior ISA with as little as £1, which is far lower than any of its peers, and every client has access to unlimited human advice from a qualified investment advisor. Now, Wealth Simple also provides ethical investing options and produces an online magazine in an attempt to demystify the world of money. Money to the Masses podcast listeners can get their first £10,000 with Wealth Simple managed free for a year if they sign up at wealthsimple.com/money to the masses. You can also check our full review of Wealth Simple online at moneytothemasses.com.
Hello and welcome to episode 271 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, how you doing?
I'm good, Andy. I'm excited about our pension Q&A Facebook Live event that we're going to do in about 2.5 hours actually, because we're recording this podcast Friday morning and then I'm doing the Q&A Romy from PensionBee actually at 12 p.m. on Friday, which once you listen to this podcast it's going to be in the past, but you are going to be able to watch it in the in our Facebook group. So if you sent in questions, which loads of you have, I mean, I think it's been probably our most popular Facebook Live we've done in terms of questions we've received, and we're not going to be able to do them all, so we're going to sort something out around the questions we've received and not been able to do on the Facebook Live, otherwise we'd have been there for days. But I'm pretty excited about it, so it's always nice to do these things on live and also get somebody else in as well. So yeah, I'm quite excited about that.
Great stuff. So if you want to see that, it is facebook.com/groups/money to the masses, and it'll be nigh on at the top of that page, and you can click on that and watch it to your heart's content. So I suppose that brings us on to what we're doing in this week's podcast. What are we doing, Damien?
Well, one piece is inspired by that upcoming event. I've just realised, looking at the questions, people generally speaking are struggling with the idea of what happens when you get to retirement. This idea of when you access your pension, and in particular something called drawdown. So I just wanted to run through what that is. So when you have a pension pot, we're talking defined contribution. So a pension pot you pay in and the pot grows over time. What happens when you get to retirement? So for some people they'll know this, but for many people they don't quite understand the sort of mechanics of it. So I just wanted to go through that as a kind of seminal piece to give people some general knowledge on it. I also want to talk on investments, the lessons learned from some of the billionaire investments, particularly actually Warren Buffett. So there's been a lot in the press of late. If you watch the Midweek Market Show or listen to it as a podcast, I talked about Warren Buffett a couple of weeks ago and another billionaire investor whose surname is Tepper, who have both made some kind of calls on where the market's going. And there are some lessons you can learn from people like that because they've been incredibly successful. And then the final piece, in honour of National Numeracy Day, that was this week. And as somebody who has a background in mathematics, I wanted to do a short piece about some money hacks, so sort of number hacks that are useful in the money world.
Excellent. So what are we going to start with this week?
I think we'll start with the investment piece. So as I mentioned, Warren Buffett is arguably one of the most successful investors of all time. I think the last check he was about the 4th or 5th richest man in the world or something like that. And so Warren Buffett, if you don't know, is a value investor. So that means he will go and buy companies based on their valuation being attractive. So he will look at a company, look at their accounts, look at what the company does, take into account the environment in the background in terms of like consumer and macro background, and then he will ascertain whether a company offers great value, and he holds these companies, these shares, for the long term. And he's been obviously doing this for decades, and he has basically an investment company that he does this through called Berkshire Hathaway. And the amount of money you would have made if you'd had Warren Buffett invest your money over the decades is incredible. I haven't got the stats to hand. I was writing about it recently, but it's mind-boggling. It outperforms the wider market, and it's because he's very much a conviction manager, where he will buy companies that he likes that may go against the grain of what other people are doing, and he will hold them for the long term. A popular holding of his might be somebody like Coca-Cola. He basically likes companies that you will use for the long term. Companies that have a lot of value. Amazon is a holding that he's got at the moment, I think. So, as I say, it makes him sometimes contrarian. It does mean that he can have periods of underperformance. It does mean he has periods of huge outperformance, and he will avoid particular sectors. So he isn't a big fan, if you think of it, of the sort of tech world. He's normally tended to steer to some of the more typical, I would say, old school type of industries, but he's incredibly successful. Whenever he does anything, the market listens and the market tends to move. And we had that in the last 2 weeks where he sold out of his airline stocks, which is something I'll mention in a moment. So if there are lessons you want to learn from an investor out there, then Warren Buffett is the guy you probably want to listen to. And he does speak quite eloquently about investing and about his views on life. So I'm going to run through some lessons that you can learn from Warren Buffett. Some of these are things he's actually said. Others are things you can just observe about the way he runs money. So the first one is a big one that he often says is invest in yourself. So that might seem a little bit odd. You might think the first thing that he would really be talking about is how to pick a particular stock, where to invest. But for Warren Buffett, his invest in yourself is a message about investing in your own skill sets. So trying to optimize or maximize your potential by investing. It could be in your education. And I like that for somebody who is famous for being all about being a fab stock picker and trying to beat the market over the long term and achieving that it's about investing in yourself. And I like the idea of that because it resonates a lot with what we talk about on things like Money to the Masses and on the One Giant Leap podcast, and we've done our live events about how one of the best ways to grow wealth is investing in yourself. So if you want to create a company, maybe you acquire a certain expertise which you can then use to build a company or to build a service or help people. So invest in yourself is his number one life lesson. Don't watch the market too closely is another lesson that he has. Trust in the process. So when you invest, whatever process you have, you should trust in it, because it will mean that you are not investing based on your emotions. And all of us get caught up in that. That's either fear of missing out or just fear of the market collapsing. And it means that you start to make knee-jerk reactions. Now, 80-20 Investor, for example, is built on a process. Some of that process is based around momentum. Some of that is based around individual research articles about particular nuances of the market. And so the idea is that you will trust in a process of whatever you choose. And it may mean that you make very uncomfortable decisions. So when the market is collapsing, you may be buying. When the market is really high and it continues to rally, you may be selling. So Warren Buffett has experienced numerous highs and lows in markets. He's gone through numerous economic cycles and bull and bear markets. And so his whole idea is to trust in the process. Whatever your process is, if it's repeatable and it's robust and it has results that have been proven over time by yourself, then trust in it, particularly when things become uncomfortable. Another lesson is say no more than you say yes. And that means say no to investment opportunities. That might mean say no to particular opportunities that come along when you're running your business or whatever it is, because it's easier, in his view, to avoid getting in the hole than it is trying to dig yourself out of one. And I suppose to give that an example in the investment world, let's say you suddenly jump on the next fad or some hot tip of a stock, and the stock or the market then tumbles 30% or 50%, then you've got to make a lot more money to get out of that hole. So if the market falls 50%, you've actually got to make 100% upside to get back to where you are. Whereas it would have been easier if you'd said no, and then you wouldn't have actually had that drawdown. That is easier said than done, of course. But the idea is not necessarily jumping on things, looking at things rationally and not being afraid to say no and miss out on something, because the preservation of capital is also important when you're trying to grow wealth. Keep it simple, stupid, that KISS acronym, where you try and keep your process as simple as you can. And it relates almost back to the idea of trusting your process and not watching the market too closely. One thing that we do have in this world of mass media and the internet is we have a flood of data or inputs that can overwhelm, and therefore you can start to make jittery decisions based upon some of the nuances that come out, Donald Trump's tweets or whatever, and you can end up just chasing your tail. So keeping it simple, not overcomplicating it. And like Warren Buffett still does things the way he's always done, where he'll sit down and he'll get out the company's accounts. He will still sit there and plug away at looking at the numbers and crunch them himself. And in his own view, it's relatively straightforward what he does. He's buying and holding things that he thinks have value for the long term. And so keeping it simple could be, for many people, investing via passives, for example, and picking a particular vehicle that they like and sticking with it. And that is a great lesson, I think, and something I've even experienced myself, that sometimes you try and overcomplicate things that actually undoes a lot of the good work you're trying to do and also adds costs. Don't borrow money to buy stocks is a big thing that Warren Buffett bangs on about. So leverage, you have to be careful of, because leverage works both ways. We did a podcast once, I think, on this, where we warned about leverage. If you borrow money to invest, then you will experience some fantastic upside if the market rallies, because you're borrowing more money to invest in that. But of course, leverage works the other way. If you borrow money, it amplifies your losses if the market collapses. So don't do it, is my general message. The people who do it are very experienced, fine. But for the most of us, I think it's a dangerous game that you can get caught on the wrong side of. And there are a number of ETFs out there that can be like 2 times, 3 times, 4 times, 5 times levered. So they can mirror maybe the FTSE 100 5 times. So if the FTSE 100 goes up 1%, you're going to get something like 5 times that on the way up, but you'll get it on the way down. Obviously, bear in mind that investment trusts do have an ability to borrow to invest, but it's tempered. It's actually got restrictions. I think it's only about 15% of assets they can do that. But there are rules that keep that tight, so managers can't go too crazy. Be fearful when others are greedy, and greedy when others are fearful. It's the most famous quote that comes from Warren Buffett. And perhaps in this environment, it's interesting that he has bailed out of airline stocks, and he never used to like them. And in 2016, I think it was, he got back into the airline industry. And he obviously, when Warren Buffett buys stocks in a particular company, he buys a lot. We're talking billions of pounds worth because of the size of his fund. And that's why he moves markets. But it's interesting at the moment, he's sold those and has raised his cash position. And there was another billionaire that's come out. I mentioned it on Midweek Markets this week, who is again another successful millionaire. He also sees the market as being overvalued at the moment and aligned with almost the dot-com era. And if people like Warren Buffett like to buy when other people are fearful, but they're not buying yet, does that suggest that he thinks that people could get even more fearful? There's reasons why people should be more fearful at some point in the future, at which point he will buy, because he said he didn't see many attractive opportunities. But as a lesson, it's a good one, because sometimes you might have to fade your own emotions. So you might have to buy more when you feel fearful, not just when other people are, or sell when you're being greedy. So it's always about checking yours and other people's emotions. But I want to just quickly throw in a couple of other lessons in there that are probably more to do with how he's behaved recently. And one of them is admit when you are wrong. So admit when you've got an investment decision wrong. And with the airlines recently, Warren Buffett came out and said, yeah, I got that wrong, which is quite a statement, really, because for a lot of people who are in the investment world, it's all about ego. And he said he got it wrong on the airlines, and he didn't want to be in them any longer, because obviously we're in a world of coronavirus. The world has changed, airline travel has changed, and they're burning a lot of cash. And so he didn't want to be in those any longer. But it also leads on to another lesson: to cut your losses. So there are times where Warren Buffett has demonstrated, like now with the airlines, where he has cut his losses because he thinks there could be much more downside and there could be better opportunities elsewhere. It's a painful thing to do, but sometimes it's the right thing to do. So it's probably one of the most popular questions I'm asked on 80/20 Investor: should people sell at a loss? I can't tell people what to do, but one thing that I would say is try, when you invest, not always focus on the point of entry, the price you paid, because the idea of an investment, and this is again something Warren Buffett talks about, is if you look at the portfolio and you look at an investment you may have held, regardless of the performance, if you were to invest today, would you buy that investment? Are the reasons that you bought it previously still valid for holding it? If the answer is no, then that gives you a hint that perhaps you shouldn't really be holding it anymore. And if it's yes, then it's a reason to continue to hold it even through a downturn. So admitting you when you're wrong and cutting your losses are things that great investors do from time to time. And the other thing is to learn from your mistakes. I mean, Warren Buffett is a good example of that. And perhaps in the current period, we're getting a demonstration of how he is learning from his mistakes, even if he isn't vocalizing it. Because over the, say, 30, 40 years or however long it is, it's longer than that, I think. It's about probably 50 odd years that he's been running his investment vehicle. I mean, he has outperformed the market massively. I haven't got the numbers to hand, but you can just Google it online and you can see it. It's incredible. But in the last decade, so pretty much since the bottom of the market after the financial crisis, which was around about March 2009, if you draw a chart of Berkshire Hathaway, the share price versus, say, the S&P 500, he has underperformed it. Now, like anything in life, you can pick a time frame that can prove your point, but he has underperformed it. I mean, not hugely, but he has. And it's something he is aware of because obviously people like to beat him with it. But over the long term, he has obviously outperformed. But one of the arguments people would say that Warren Buffett has done in the last decade has perhaps not quite got to grips with the way the world has changed. So we became even more online. As consumers, we became much more focused on companies like Amazon doing stuff differently. The world had changed from the world of the 1990s and early 2000s. So perhaps Warren Buffett, by dumping airlines and making a comment towards how the world has now changed post-coronavirus, is an acknowledgement that the world does actually change. And perhaps in the last decade, he wasn't quite as quick to realise that as other people were, or the wider market was, that the world has fundamentally changed. And some of the old world stocks that he still holds have underperformed. So perhaps that is an example of learning from your mistakes, acknowledging when the world has changed and then moving with it. So I think that's quite a nice roundup of some lessons that you can learn from somebody like Warren Buffett, who is, as I say, arguably one of the most successful investors of all time.
That's interesting stuff. I've been reading a lot about Warren Buffett lately, Damien, and I've only ever really read about Warren Buffett. I hadn't really seen much of him, and I saw him on the telly the other day, and I was really surprised. I don't know why, because I kind of know how old he is, but I was surprised by how old he looked. And obviously he's got this big investment vehicle going on. And how much of it is he actually doing himself, do you think? Obviously he's got a massive team of people. It goes under his name, but how much of it is he still signing up?
It's him. It is. He does the AGM, the annual general meeting. He's sitting there explaining why the decisions are made. And you're right, Warren Buffett, I think, is actually 89. He'll soon be 90. And there's another guy as well who is sort of the other part of the Berkshire Hathaway investment vehicle. And he's, I think, about 95. So the two of them are central to making the decisions about what goes on in the investment world. And it's a question they're asked all the time about succession. And as he says, he's not planning on going anywhere voluntarily anytime soon, but he might be going somewhere without any say in it. And he laughs about it. But it is something that people do obviously worry about. But you're right, he's completely switched on and he's still doing it. Some people just live for this stuff. So yeah, you could be a financial analyst or reporter or whatever. It's something that he's asked about all the time, and which he does just deflect, to be fair.
So there's room for you doing what you do right up into your 90s yourself then, Damien?
I would love to think that I would make old bones, but I'm not sure I will do, given my health problems.
Well, that actually segues us really nicely, talking about old bones and retirement. So we're going to be looking at pensions next, and particularly you want to focus on Drawdown, what it is, how it works, and that kind of thing. So yeah, Drawdown, pensions.
Yeah, so I want to give people just a kind of an overview of what pensions and drawdowns is. And so I suppose when you get to pension age, what I'm talking about here, I'm not talking about secured income, so things like defined benefits, final salary pensions. That's parked to one side. That's over there. We're not going to be talking about that. We're talking about what most of us will have, which is a defined contribution scheme, which is you put money into a pot, the pot grows, and at the end of when you get to retirement, after 55, which is the earliest age you can access it currently, you will do something with that pot. I'm also not talking about annuities, because obviously you can take a pension pot and buy an annuity. And an annuity is you give some of your pension pot to an insurance company, for example, and they will take that money and go, thank you very much for that. In exchange, we're going to give you this amount of income every year. And it's not going to be much. It's normally a few percent. I remember that it was 6% a few years ago, and that seemed quite good. I think it's even lower than that. So you give them 100 grand, you might get 6 grand a year until you die. And there's different variations of that setup, but you're giving your money to somebody for the guaranteed income, and there's a risk of being able to provide that. That risk is passed on to the insurance company. However, we now have something called unsecured income. You can take your pension pot and you can use that as you wish to be able to access the money and to be able to live off in retirement. And so if we go back a number of years, so if you go back before 2015, and what happened, there was something called Drawdown that came along. And what you were allowed to do, there were two versions of it, flexible drawdown and cap drawdown. And it gave you the ability to generate an income, or take an income, I should say, from your pension pot while it remained invested. So it was still in whatever you wanted it to be. It could be funds that invest in stocks and shares or bonds. And then you would take money out every year, month, whatever it was. And your pot was there. It had to sustain it. If you took too much, it ran out. Tough. That was it. You had no more money. And so you would have to manage that. You could live off the natural income, the yield, or you could just cash in bits of it as you went along. But there were, as I say, there were two types, capped and flexible. Capped limited the amount you could take. And it was in reference to something called GAD levels. We won't dwell on it, but what it really tried to do was stop people raiding their pensions. It had a kind of reference to what you would get with like annuities. That's what it was trying to do. It was trying to make sure people didn't deplenish their pots too quickly. And then there was a flexible version, which if you had enough income from other sources, you could be a little bit more free and easy. You could take a bit more from your pension. What happened after April 2015? Pension freedoms came along and they created something called Flexi Access Drawdown. That was basically a product or a means to access your money much more freely. And so on a very high level, what we are able to do now is cash in your pension if you want to, is one option. So when you say cash in, you can take all of your pension out in one go. You could take it out in regular installments, or you could take ad hoc. And of course, when I say you could take regular installments, that could be, as I say, it could be the natural income yield, or you could just take out chunks of it. At a high level, that seems very simple. But of course, there are nuances to all of these things, as there always is, and things you should pay attention to and think about. And one of those is taxation. So what I want to do is just explain very high level, as I said, about how taking your money works when you get to retirement age. I'm not assuming you're taking an annuity. That's always an option, that you can use part of your pension to take an annuity, or all of it to take your annuity. I'm assuming you're not going down that road. So the first thing you could do, once you got to the age of 55 or older and you decided you wanted to access your personal pension, or whatever it is, a SIP, you could decide, I'm going to take it all. And typically 25% of that sum will be tax-free cash. So they call it a pension commencement lump sum. I'll call it tax-free cash because it's just easier to call it that. So 25% is tax-free, and then the remaining 75% that you take will be taxable, and it'll be taxed as income, and it'll be taxed ultimately your marginal rate. It can mean when you get that money that it can be taxed at a higher rate than it should be, because of the way basically PAYE and taxation works. So you have to make sure you understand the level of tax. So if we said you had 100 grand pension pot, you took it, I'm cashing it all in, 25 grand will be typically tax free, 75 grand will be subject to income tax. Well, you can see if it's taxed as income, very quickly you're going to go beyond the basic rate tax rate of 20%, you're going to hit 40% taxation and stuff like that. So as the pension pot gets bigger, the rate of taxation gets higher. You can, if you don't want to do that, you might be sitting there thinking, do you know what? I don't want to access my pension. I just want a chunk out of it. And what they did is they created something called, it was an acronym. I don't like it. People call it UFPLUS, UFPLS. So it's an uncrystallized fund pension lump sum.
I can see why you don't like it, by the way. That's awful. UFPLUS.
It's just, the thing in the pension world is just, in finance world, there's so many of these acronyms and nuances. But what this does is it solves a problem. Somebody says, look, I just want to take a bit of it. And so they take a chunk of their pension. And rather than take the whole lot, they might take a small amount. And then 25% of that chunk is tax-free. And the remaining 75% is taxable. So they might only take, like I say, 40 grand. And then take 25%, which is 10 grand tax-free, and then the rest of it is taxed as if it's income. Of course, when it's taxed as if it's income, you've got to take account of your personal allowances, etc., and income elsewhere and everything like that. Of course, you could then do something slightly different, which is what Flexi Drawdown is. So Flexi Access Drawdown, I've seen it called, but Flexi Drawdown, let's call it that. what essentially happens is that you've got a pension pot that's pre-retirement. You can move all of that post-retirement. So you go, right, I'm retiring. And you might take 25% of that money as tax-free cash. But the remaining 75% is then used to provide an income ongoing for you. And that can be how you do that is up to you, what you invest in, but it's going to be used to provide an income. So you will have a flexi drawdown plan. And now plans now are flexi drawdown. The idea of capped and flexible drawdown you had in the days gone by have gone. People who had the old cap style can still be in it, but if they want to change it, then they'll move across into this new flexi world. People with flexible drawdown, they will automatically move across to this flexi drawdown plan. So it's a little bit convoluted, but what it means is that you can use your pot in flexi drawdown to take your tax-free cash and then be used, still invested, the remainder that is, to provide this income. But you have other options. This is the great thing about it. It's flexible. You could, in theory, just take the tax-free cash and have the money obviously move across the line into the retirement world, but you don't have to take any income from that 75%. You might sit there and go, well, I don't want to take the income from it because the problem is I'm still working. I don't want to pay the extra tax. So you could decide, if you're still working, I'm going to basically access my benefits, move it across into this retirement, across the retirement line, but I'm only taking the tax-free cash. I'm not, even though the benefits, the 75% now is across the retirement line and is seen as such, I'm not going to take any income from it. That is possible. So that's why it's attractive to some people. But also you can see that you could phase it. So you could have phased drawdown within your plan where you just move parts of it across the retirement line. So you could keep some of it into as it was pre-retirement, untouched. You can move a chunk across the retirement line, take 25% as tax-free cash, and then the rest of it you could do something with the income over there to provide income or not. And it's great because it allows people the flexibility to access their pension as their life dictates, so their circumstances. So one of the things I want to mention, why I mention this, is because I want people to realise they have options, but also that the options aren't always that straightforward. The high idea of it, that you want to access some of your pension, or you might want the tax-free cash to pay down some bills or to build your extension you've always wanted, exists. But I would say when you go to access a pension, without fail, it is almost the one time in life where you should seek the advice of a financial advisor. The reason I say that is because I've given a very brief description of how drawdown works, but enough so people understand it, that they have this ability, this flexibility to be able to access their tax-free cash, derive income, but also to manage their tax bill. If you'd listened and worked out there, actually, I could phase my retirement so I could actually mitigate the amount of tax I pay, because I don't want to pay all that tax on 75% of my pension pot because I won't get much of it back, or I'll get much less of it back. But if you do it in installments, you can start to mitigate your potential income tax bill, because don't forget, if your wider income starts to reduce elsewhere, you could get to the point where you start to access your pension and you reduce your tax. To give you an example, when I used to work in the city, we had people who obviously were clients, lawyers who are very, very rich. They paid money into a pension, got all the high rate tax relief on the way in. They loved it. The plan was always, when they retired, they would manage their income levels, so they would never pay more than basic rate tax on what they take out of a pension. Because remember, you get tax relief on the way in on a pension, on the way out you're always taxed. And so they could get their tax-free cash, no tax, but they would take their income and they would mitigate it so they would pay less tax in retirement. So you can see that's attractive. You could get huge amounts of tax relief on the way in, 40%, but only pay 20% on the way out. So a financial advisor will help you manage your pension and what option is best for you, because one of the things you have to realize, tax efficiency will drive a lot of what you do, because you might have income elsewhere. You may have other pots elsewhere. You may have ISAs, you may have other investments, you may have cash, and drawing an income, how you do it should be viewed across the whole pot, the whole board, all of your wealth, to see which is most tax efficient. And a financial advisor will help you do that. The other thing to bear in mind, that accessing your benefits in differing ways has impacts going forward. It might limit what you can do in the future. So one example is that everybody can put money into a pension pot, and it's up to £40,000 or your earnings, whichever is lower. So if you're earning a decent amount of money, you may be able to put as much as £40,000 into a pension a year. There may be people who want to continue working and want to put money into their pension and continue to do so. But what they're thinking is, I wouldn't mind some money out of my pension for, I don't know, they might want to do the house up or an income boost. The issue they've got is if they can potentially cap the amount of money that they pay into their pension going forward, because they may want to continue contributing to a pension pot and building it up over time, because they're not really thinking of retiring until, say, 65, and they're making this decision maybe about 55. They want to just do the house up. You can end up restricting the amount you can put into a pension going forward to as little as £4,000 a year, and it's called the Money Purchase Annual Allowance. I'm not going to dwell on it. I think we will probably end up mentioning it in the pension live Q&A that we do today, but a financial advisor can help you manage all of that so you don't limit your options. The other thing, the things you should bear in mind when you're accessing Drawdown is existing benefits you have in a pension plan, that you don't change something that has an impact on that. The other thing you might have to bear in mind is you may need to transfer your pension to be able to access flexi drawdown. So some old style pensions might not be able to give you the access that you want, so you might have to move it, but you have to bear in mind what you're giving up if there's anything. Consolidating pensions could make sense in this environment, because the issue you also have is if you have lots of different pension pots all over the place, once you start accessing pensions, say one of them, you have to start telling the others what you're doing, because you all have this lifetime allowance, which is something you also have to bear in mind, which effectively is an allowance that limits the amount you can take out of pensions effectively before you get taxed. Now, yeah, it's a big number. It's north of £1 million, but for some people, they can hit it. You just have to bear it in mind. And a financial advisor will be well aware of all these rules and will help make sure you don't do anything that you later regret. Also, pensions benefit from generous inheritance tax exemptions effectively, because they are outside of your estate. So you can pass your pension on to your next generation, potentially with no taxation. So that's attractive. So if you're thinking about passing your estate on to people and how your children or your dependents might inherit your money, then there is an argument that you would want to deplete your pension last, because it is already outside of your estate. If you access it and bring the money into your estate, then what you've done is you've just given the tax man the potential to take some of that via inheritance tax. So again, it's another part of planning that you would speak to an advisor about, and it'd be worth its the weight in gold in terms of their fees. Other things to bear in mind are small pension pots. There's certain rules about accessing small pension pots which are different. So these are things like, say you had a £5,000 pension pot that from an old employer, there are rules that enable you just to access that, which don't have such wide impacts going forward. So hopefully there I've given people the idea that there's a lot of options when you come to retirement. So they all fall into the category of being able to take all of your pension, taking regular installments of it, or taking ad hoc. And the way you would generally do that could either be via this idea of unfunded pension lump sum or via flexi drawdown. And you can make it so you can mitigate tax. Taxation is a really big thing about all of this. So make sure you seek financial advice.
Okay, so that moves us on to the final piece of the podcast. National Numeracy Day has been this week, and Damien, you're a man who loves numbers, and you've got some tips to share that can help you in the wider world of finance.
Yeah, I mean, my background is, like you say, numeracy, numbers. I mean, I did a degree in mathematics many years ago. I do have friends who laugh at me, though, because they do argue that when it comes to splitting a bill 4 ways, when we go out, that I'm not necessarily the quickest by any stretch. So it could be that I'm just trying to fudge it so I pay less. But no, it's occasionally, I think it's the alcohol. But as soon as alcohol and numbers, I'm done.
Yeah, I had a misspent youth playing darts in pubs, and it was amazing how quick I was at being able to subtract.
Yeah, see, that's a good example where you get very good at numbers. Because do you know what? This is the thing. You don't have to have the best mental arithmetic in the world to do a maths degree. And people might find that odd. You really don't. Because a lot of it, you don't even deal with numbers. I won't dwell on that, but you don't.
It's to do with patterns and processes, right?
Yeah, some of it is not even numbers. It's theoretical stuff that has no numbers.
Ah.
So you disappeared into a different world. That's why a lot of maths lecturers are very strange people. They inhabit an alternate universe. So maths and finance go hand in hand. And I just wanted to do a couple of quick maths hacks because National Numeracy Day is a day they do every year that's just to show the importance of numbers in our ongoing lives. So it's just to sort of reiterate it and help people understand. They do cool quizzes, show people that maths is easier than they think it is. So on that theme, a couple of quick maths hacks. Now, this was one that blew our minds away. It did the rounds on social media not long ago, and it's the idea of quick percentages. So if I asked you to do 20% of 75, so tell me what 20% of 75 is.
It's 15, I think.
People would have to sit there and try and work it out. And Andy's done pretty well there. But the trick is that 20% of 75 is the same as 75% of 20. So if you flip it round the other way, the answer is the same. And that blew the internet's mind when somebody pointed that out. I think there was the answer. The question was, what was the one thing that somebody told you that blew your mind? And somebody, it wasn't even doing maths, and somebody put that as their response. And everybody was like, how did I not know this? So yeah, 20% of 75 starts getting down into probably decimals when you're trying to work it out, etc. That's probably an easier one because you use 20%. But working 75%, 3/4 of 20 is far easier. Like Andy said, it's 15. Equally, taking that one step further, if I said to you work out 62% of 54.
Yeah, I would have no idea. The reason I absolutely banged the last one out is because I always do 10% of something and then double it. So I made it sound easy. Now, when you were working with 2%, 62% of 54, did you say? Yeah, no idea.
Yeah, so what we're going to do here is instead you would flip that round and it may be 54% of 62. But the idea is you round down at the same time. So what you're really doing then is if you flipped it around and then you round up or down, so you do a bit of rounding. So this is going to be an estimation. You're working out 50% of 60, and that's 30.
Yeah.
And the answer is actually, I think it's about 32, 33 or something like that. So it gives you an estimation. So it's quite a neat trick of trying to work out percentages very quickly to give you an idea. And that's useful in any walk of life when you're doing numbers, whether it's money or anything like that, and particularly in finance. The other rule I want to do is one I've spoken about before, the rule of 72. So the rule of 72 states that if you want to know how long it would take for your money to double on a given interest rate or investment rate, then you divide the number or the interest rate into the number 72. So if, for example, you had a return of 10% a year, then divide 10 into 72, that's 7.2. That means it will take you 7.2 years for your money to double. Well, 10% is obviously very attractive. Interest rate's quite high, but you can see that you very quickly can work out how to double your money. But I work normally with a rule of 70 because it's far easier to do. So if you get the 5% a year, which is a much more realistic rate of return, say on investments, equities, divide that into 70, that gives you 14. So it will take you 14 years to double your money. I think it's a very useful rule. And the one stage further, I hadn't actually heard this one until I was doing some work for the podcast, is the rule of 115. And it's the same principle, but it's about trebling your money. So you divide the rate of return into 115, and that will tell you how long it takes for your money to treble. The next one is based upon your hourly rate. A very useful idea in finance I've spoken about in a past podcast. When you're trying to work out whether something represents value or whether you should spend money on something or whether you're trying to control your spending, is to know your hourly rate. So how much you earn per hour to do the work you do. And therefore you could look at an object and say, well, that's actually going to take me 4 hours of work to earn the money to buy that. Or maybe it might be 30 hours if it's something really expensive that is perhaps a bit frivolous. And you sit there and think, would I really do that? Is that good value? And then it may help you in terms of your spending. The difficulty is no one usually knows what they get paid hourly, or most people don't if they're paid in an annual salary. Some people know their hourly rate, lots of people don't. If you're fortunate enough to know your hourly rate, that's great, you know what it is already. If you don't, then the quick way to work it out is to take the 3 zeros off the end of the amount you earn and then divide it by 2. So if you take the average wage in the UK, it's about £25,000. You take 25,000, knock the 3 zeros off, that gives you 25, divide it by 2, then your hourly rate is £12.50. And it actually works out, it assumes you work about a 38-hour week when I did the numbers. So that's a good trick. You'll very quickly know what your hourly rate is, and then you can apply that when you're trying to work out what the value of things are.
Do you know what, Damien? That's an absolute eye-opener for me. I've worked in payroll for many years and having to work it to decimal places. And for quick maths, that is incredible. That was just a point percentage off the exact number. So that is brilliant. Well done.
I didn't know that one. I mean, I hold my hand. I didn't know that one before today when I was doing some research. So I really like it. So it's going to be one that I'm going to absorb and probably fire out when we do talking about things and do with money. Half your age rule. This was on episode 223 of the podcast. So I'm just bringing it back. Go and listen to episode 223 for the full lowdown on this rule. And the idea of the half your age rule is that you should save half of your age as a percentage of your salary into a pension. So if you're 30, you should be saving 15% of your salary into a pension. So every month, 15% goes in, and then you should have, hopefully by the time you reach 65, a comfortable retirement. Now go back and listen to that episode, because there is a nuance in this. It doesn't quite work. You need to fudge it slightly as you get a little bit older, but it's a useful rule. It's something as a benchmark. But as I say, it's not perfect, so I'm not going to go dwell on it now because I've done it before. The other one I want to talk about is the rule of 13. Now, I did this on a video years ago. We need to talk about money. And I was watching them. I got stuck in a loop on them actually today, watching myself do these 1-minute videos. And I did lots of 1-minute videos on things to do with finance, investing, debt, you name it. And I coined this idea of the rule of 13 to do with your pension. How much of a pension pot do you need to have a relatively comfortable retirement? So let's say you are earning £25,000 a year. How much do you need in your pension to have a similar lifestyle as you do now? And the idea is to times it roughly by about 13. I worked it out. So you would take 25, times it by 13. See, that will just prove the fact I can't do very quick maths there, Andy. It's 250,000 plus 75,000. So that's what, 325.
I'll cut it out in the edit. Don't worry, Damien. I'll make you sound good. No, I'll leave it in. Leave it in, Andy. So you're going to have £325,000 roughly in your pension pot if you earn an average wage of £25,000 a year. And it's not a given, but the way it works is that you've probably paid off your mortgage, you get 2/3 of your salary, and then it works out. That's roughly, you always work on an assumption that most people want 2/3 of what they're earning as their pension every year. So you would get about a £16,000 pension a year with a decent withdrawal rate of about 5% if you had a pension pot that was 13 times what your yearly wage was. So I think that's a good benchmark. It doesn't take account of your state pension. I always view that as a Brucey bonus that then goes on top of that. So that actually means you'd have a pretty decent retirement. It gets much nearer towards the £25,000 that you already had. So there you go, Andy. And there are others. I mean, the 19-year sandwich is something I've done on those videos on YouTube as well. So I'm not going to do that one. If you're interested, it was talking about debt, how long it takes you to pay back, with in reference to a sandwich as a ridiculous but powerful example. So we're done, Andy. I think we covered a hell of a lot actually in one podcast, but hopefully people found that incredibly useful. We have indeed. I've learned a lot myself. So that's it for this week. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. Don't forget, we are on YouTube, we're on Facebook and everywhere else. We've mentioned the Facebook group earlier, but I will mention it again because there is the pension live Q&A with Pension Bee and Damien, and that is facebook.com/groups/money to the masses, and you can watch that video in full. We're done, aren't we, Damien?
We are done. That is it for this week. Again, don't forget to leave us a review. We've had some nice reviews in the last week or so. We need more, and we will read some of them out in the coming weeks.
And you might even get a mug when we can get into the office and get those posted out. Right, until next time.
Until next time.